Hello and welcome to the third episode of The Officials Explain. In this video, we're going to explain why Dated Brent is key for the entire oil complex and why it's crucial for anybody wanting to trade oil to understand it. So we mentioned the North Sea in our latest episode of the Flux News podcast. So today we're going to explain a bit more of the physical components and the window structure that make up the Dated Brent complex. So at The Officials, we're all about bringing transparency and clarity to the pricing process to allow you to better understand the physical and financial oil markets. So what today is really about is to explain this critical aspect of the oil market, because around 3/4 of all physical trading is settled via Dated Brent. And you can get some really volatile products in this basket as well, which we're going to look at later. So make sure to stick around to the end. Dated Brent is a physical North Sea benchmark with, as you might expect from the name, dates attached to the delivery. So in our previous video about Dubai, we were talking about a monthly structure where you're trading partials of 25,000 barrels for 2 months ahead. So you're trading May barrels in March and June barrels in April. Whereas in the North Sea window, you're trading 10 to 30 days ahead for a variety of crudes in a slightly different structure. And why this is important is that the pricing system is a bit different in the North Sea. You still have this minority of physical players and trade houses, producers, majors, etc., who have a disproportionate impact on the pricing, which, as I mentioned before, is so important for 3/4 of all physical trading. But in this way, it's different to Dubai, and you need to know the differences very acutely. To start off with the window, as I mentioned, you can trade these cargoes for a given date. So you'll see players come in and bid or offer for a certain grade for particular dates. So for instance, you'll see Trafigura bidding for a WTI Midland for the 10th to the 15th of May. And that means that Trafigura wants to buy a Midland cargo, and cargoes in the North Sea are 700,000 barrels rather than 500,000 as they are in Dubai. Trafigura therefore wants to buy a Midland cargo for the 10th to the 15th of May for whichever price it wants. Equally, you'll see sellers coming in and saying, I'm offering this, for instance, Forties cargo for the 5th to the 9th of May at this price. And the prices that you see in the window are done as a differential to dated. So you'll see Trafigura, for instance, bids dated plus 220, or you have VTOL offers Forties at dated plus 120, whatever it might be. You also have what's called the physical differential, which relates to these prices and gives you an idea of how strong the physical is pricing, how strongly the physical is pricing. And if we look at my screen, we've got the graph of the physical differential since the end of February. So as you can see around here, the physical differential is around 0, which means that the physical pricing is relatively weak. And then we have a sudden jump up here towards 80 or 90 cents per barrel. And so this physical differential gives you an idea of how strongly the physical is pricing. And this is based off the window. It's also based off what's called cash BFOE. And we'll get into an explanation more of what that is later in the video. And then there's also a CFD component that comes into that, which is a weekly contract as an average of daily Dated Brent. Again, complicated. This is going to be a 2-part explanation of the North Sea. So today we're focusing on the physical. Next week we'll work a bit more on the paper and how to actually go about trading and using these contracts for your own trading. BFOE is essentially a basket of crudes of different grades. And I have a list of them here so you can refer back to in case, just for ease of reference. And this is Brent, Forties, Oseberg, Ekofisk, Troll, and Midland, WTI Midland. Now, these are the grades that make up what we call the Dated Brent basket. And that means that in the window, anybody can come in, any trader can come in and say, I want to bid, for example, for a Forties cargo, or I want to offer an Ekofisk cargo. And these grades make up this basket from which we assess the Dated Brent. And so each of these has a curve. So similar to the futures curve, it has a price over a certain amount of time. And the way to think of it is that the most competitive or the lowest cost of these grades sets Dated Brent. So the lowest of these is what determines the price for Dated Brent for a given day, given session. Given these are different grades, there are certain complications. Obviously, it would be too easy otherwise. So each of them has or most of them have an adjustment factor or some kind of freight or desulfur escalator, for example, that will affect the price. So, for instance, a better quality grade, Osberg, Ekofisk, etc., they will carry what we call a premium, a quality premium. And you have to factor that into your assessment when you're building the curve for each grade, so that you're giving a kind of a level playing field across these grades. And then when we come to Forties can have a different amount of what's called buzzard, which is another lower quality grade that is blended into the Forties that changes perhaps each week. INEOS provides an update each week on the buzzard content in Forties. And this sulfur de-escalator is monitored and edited so that it reflects the quality of the Forties grade. Midland is another case because, of course, that comes from the Gulf of Mexico, Gulf of America, whichever term you prefer these days. But you have to then consider the freight cost. So Midland has what we call the freight adjustment factor, which refers to the cost of shipping from the Gulf over to the North Sea, because you have to deliver this crude physically into the North Sea. That can change every day, and you have to update that again when you're building your Midland curve. And that brings us on to freight as well, because there are many factors in play here, and freight is one of the important ones, because you can bid or offer, trade two different types of freight, two crudes coming with different freight contracts. So there's CIF, which stands for cost, insurance, and freight, meaning the seller is responsible for the shipping, the freight, and all the risks involved in that process. So often you'll see that this carries a higher price because the seller wants the buyer to compensate them for taking on that responsibility, that risk. And then you have FOB, which means free on board. That is where the freight is the buyer's responsibility. So the buyer has to then take on the risk of shipping, etc. So you end up with a difference there that you have to iron out. You have to work out the difference between the two and in order to build your curve. So as you can tell already, there are a lot more factors at play here than there were in the Dubai video that we explained last week. So once you've taken all of these into account, you can then build your Dated Brent assessment. So you build the curve for each of these grades, and from that you decide, or you judge, which is the most competitive of the grades. You take an average of the 10 to 30 days ahead to work out your Dated Brent, because those are the delivery days. So you can bid and offer, trade 10 to 30 days ahead, and then compare that to your cash BFOE curve and CFD curve in order to build what we referred to earlier with the physical differential. Now, cash BFOE works again in the window structure where you have buyers and sellers coming in and bidding and offering for these, what we call again, partials. Unlike Dubai, there is a difference. These partials are 100,000 barrels and they are for a monthly structure again. So at the moment we're in April, so you can have traders coming in and bidding or offering for June, July, August BFOE. And from that, you can then take an assessment of the BFOE curve and decide how that structure has moved, and that informs your Dated Brent assessment. But we'll get into that actual assessment process in more detail next week. That's essentially the physical side of things. And then there are a few financial contracts that you have to consider, derivative contracts. So the first of those will be the CFDs. So on my screen now, we're looking at the CFD for next week. So you have a CFD for BAL week, which is balance of the week, which is this week that we're in now. So that would be the week beginning on the given it was a bank holiday, on the 22nd, because there was no trading on Monday, but normally it begins on the Monday. And then you have one for the beginning next week, so the 28th, and the week after, and so on, down to for a few weeks ahead. And you use these to average out and interpolate a BFOE curve that is smooth, that allows more granular hedging and more granular assessments of the Dated Brent structure. So the reason this granularity is important is that it allows the traders to be more precise with their hedging. That means that they have a more control over their hedging process, better control over their risk. But it's not only a hedging instrument, you can also speculate on it. And there is also the DFL, which we're going to come on to now on my screen now. So the DFL means dated to frontline Brent future. So that means to Brent swap 1. So at the moment we're in April, Brent swap 1 means May. So this is dated Brent against Brent May swap. And this is a way of connecting the physical to the swap curve. And again, this is pretty volatile. Like you can see towards the end of March, we had this huge jump in the DFL, which has then come off considerably. So we had it up to near $2 even, and it's come off considerably towards 60 cents in early April. It's built up pretty consistently throughout before falling again yesterday and today. So these are very volatile contracts and products. So you can trade all of these CFDs and the DFLs on Onyx Markets. And for today, that's all we're going to go through on the financial side, because that's just a taster of what's to come in the next episode. So we'll see you next week. And in the meantime, don't forget to go and check out our reports. We put out 2 reports every day for the Asian and European markets. So that's Dubai window and North Sea window. And if you'd like to read those, you can go and find them on our X page, which we'll link in the description, or on Flux Live. Thank you for watching. And you can find the video that we referred to the Dubai window and explained the pricing mechanism in Dubai in the cards at the end of this show. So thank you very much.